So let's start in here with chapter 3. And if you look here on page number 64, this whole chapter is about ownership of real estate, the ways that real estate can be owned. And this is an important chapter because I'm really going to take you through three different things in this particular chapter of the book. The first thing I'm going to take you through is the level of ownership you could have in a piece of real estate, like whether you can own the building and the land, if there's any conditions, we'll talk about that. The second thing we're going to talk about today is title vesting, the mode or method of holding title to real estate, right? That's called title vesting. And then the last thing we're going to talk about is the legal entities that could own real estate, corporations, partnerships, sole proprietorships, LLCs. So we're going to go through all that. But let's start here on page number 64 with estates and land. Now, right underneath the word estates, I would write the word ownership. So estates means ownership. So anytime you see the word estate or estates on the exam, you got to remember that the exam is talking about your ownership in some item or thing. Now, one type of estate broadly is called a freehold estate. Now, you'll see the term freehold here at the bottom of page number 64. You'll see the term freehold estate. Now, if you think of this term freehold estate, this is an ownership that you are free to hold as long as you want. Really what this means for the exam, I would write the words indefinite duration. Anytime you own a piece of real estate for an indefinite duration, it's called a freehold estate. Like, I'll give you an example of this. Your house. How long are you going to own your home? I don't know. You could own it a day, a week, a year. You could own it till you die. Anytime you own real estate, but you're not sure how long you're going to own it, the ownership could be called a freehold estate. So again, ownership for an indefinite duration is best described as a freehold estate. So again, ownership of real estate for some indeterminable period. I don't know how long I'm going to own it. That could be called a freehold estate. Now, there's three types of freehold estates that we should know about for the exam. Now, what is freehold again? Freehold is, I own a piece of real estate, but I have no idea how long I'm going to own it for. That's freehold. Now, one type of freehold estate is something here on the middle of page number 65 called a fee simple estate. So anytime you see the word fee or fee simple, you got to remember that the exam is talking about the highest form of modern land ownership. The best way that you could own real estate today is called a fee simple estate. So do me a favor here, right at the middle of page 65, next to fee simple, I would write highest form of modern land ownership. The best way that you could own real estate is called a fee simple estate. Now really, ultimately, all fee simple means is that you own both the building and you own the underlying land. You own both the building and the land with a fee simple estate. Now, what does this mean? Because, a lot of students hear that and they're like, well, obviously, if I buy a house, not only am I going to get the structure, but I'm also going to get the land under it. That's not always the case. I'll give you an example of this. A mobile home. Now, how much does a mobile home cost? I don't know, $60,000. And it'll be a nice place. It'll keep you warm in the winter. It'll keep you cool in the summer. It'll have running water. It'll have, all the amenities that you would expect from any shelter. But the reason it's so cheap is because in a mobile home, all you own is the structure. You don't own the underlying land. You pay something called space rent to the owner of the mobile home park each and every month that you have that mobile home. That's not fee simple. You own the structure, but you don't own the land. If you look at Mexico, along the coast of Mexico, all those big, beautiful hotels, the Hilton and the Hyatt and the Four Seasons, they may own the building, but they don't own the underlying land. The government of Mexico was smart enough to say, okay, Hilton, you want to come build a hotel here on our beautiful beach? No problem. But the government is actually going to own the land, and you'll pay us ground rent each and every month while you're here for the next, 99 years. That's not fee simple. Fee simple is ownership of the building and the land. It's the highest form of modern land ownership. Now, let's be honest. Out there as a real estate investor or as a real estate agent, what percentage of the deals that you'll do you suppose are fee simple? Like literally 99.99%. You could have a whole 50-year career in real estate and never see a deal other than fee simple. Fee simple is very, very, very common. Now, one thing that might not make sense right now, but it will in a few minutes, I promise. Next to fee simple estate on page 65, I would write the words no conditions. A fee simple estate has no conditions attached to the ownership. Now, I'll explain what that is in a moment, but I want to review what we've talked about so far. Ownership for an indefinite duration is best described as what? Your answer, freehold. Remember that? Ownership for an indeterminable period is called a freehold estate. Now, one type of freehold estate is called fee simple. Now, what is fee simple? Fee simple is ownership of the building and the land with no conditions attached to it. Now, is that your house? Yeah, that's your house. You most likely own the structure that your house is in, or the structure itself, as well as the underlying land. That's fee simple ownership. Now, at the bottom of page number 65, you'll see the term condition. Do me a huge favor, right next to condition, I would write the words fee simple defeasible. Fee simple defeasible. Now, think of that word defeasible. Now, that's not in the book, but that's how the state exam might call this concept. Fee simple defeasible. D-E-F-E-A-S-I-B-L-E. Fee simple defeasible. Now, if you think of that word, defeasible, what does that sound like to you? It sounds like defeat, defeated, able to be defeated. Fee simple defeasible has a condition. And do me a favor, right somewhere next to condition, I would write the words breach causes loss of title. Breach causes a loss of title. Anytime you breach a condition, the ownership is said to be fee simple defeasible if there's a condition on the land. Let me give you an example of this for the exam. Consider Archer, that's the guy's name, Archer, deeds a property to Baker on the condition that Baker never sell alcohol on the property. If Baker starts selling booze on the property next week, what could Archer do? Archer could take the property back because Baker has breached that condition. Let's say that you had a building near UCLA in Westwood. You want to sell that building to UCLA on the condition that UCLA must use that property as a science library. Now, tomorrow, if UCLA starts using that as a sorority house, what could you do? You could take the property back. Why? Because they've breached their condition. Now, most of the time, 99 to 100 times out of 100, the deals that you do, they're not going to be fee simple defeasible. What are they going to be? They're just going to be fee simple or fee simple absolute. Those are the same thing. But if there's a condition attached to the ownership, it's called fee simple defeasible. Now, let me ask you this. When is Baker, in my story about Archer and Baker, when is Baker going to start selling alcohol on that property? We don't know. Baker might follow the rules forever. Baker might start selling booze in a week or a year or in 10 years. The point is, we don't know when he's going to breach that condition. So we don't know how long he's going to own it. Anytime you don't know how long you're going to own something, what do you have? A freehold estate. So remember, freehold is this big, broad category where I own a piece of real estate for how long? I have no idea. Two types of freehold estates so far. Fee simple. That's ownership of the building and the land with no conditions. Then there's fee simple defeasible, where there's ownership of the building and the land as well, but there's a condition attached to the ownership. For example, you can't drink on the property. You can't, you must use the property for open space. You can't use the property for anything but a library, for example. That's fee simple defeasible, another type of freehold estate. Now, you'll see this chart here at the middle of page 65. This chart has a couple of examples of freehold estates, and one of these says fee simple subject to the power of termination. Now, most of the time you're going to see this on the test as fee simple defeasible. So again, fee simple subject to the power of termination, fee simple defeasible, they both mean the same thing. There's a condition attached to the ownership. Now, one more thing about fee simple defeasible that we should probably know for the exam. Let's say you bought a house last year and you're like, man, I don't remember if it was fee simple or fee simple defeasible. Now, if you were a betting person, you would definitely bet that it was fee simple absolute, not defeasible. But just to be certain, what document could you look at that would show you whether or not there's a condition to the ownership. Look at the deed, right? The deed is the ownership document that is going to determine whether or not there's a condition. So the deed might say, for example, Archer hereby grants to Baker the property known as blah, 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 on the condition that Baker never sell alcoholic beverages on the property. Right? That's fee simple. What again? Fee simple defeasible. Also a type of freehold estate. Now, let's say you go back to 1935, 1940, 1950, hell, 1960 even. There were a lot of deeds out there that had race restrictions in them. For example, there might be a deed that says, just as an example, A hereby grants to B the property known as blah, 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 on the condition that the property may never be sold to a member of any ethnic minority group. Now, you put yourself in that position, going back 60 years, 70 years, you had a lot of deeds like that. What's important to remember is that the deed itself is still valid. That deed that has that race restriction in it is valid. But the condition is not valid, of course, right? That's illegal. So the problem with saying that the deed is invalid is to say that the owner no longer owns it. So let's say my great-grandfather, let's say he was born in 1920. 1945, he bought his first home in San Francisco. Let's say that he's still alive today, and there's a deed that he has, and the deed reads, A hereby grants to my great-grandfather the property known as blah, blah, on the condition that the property never be sold to minorities. To say that his deed is not valid is to say that my great-grandfather no longer owns that property. He owns the property. He does. So the deed is valid. It's just that that particular condition is not valid, nor is it enforceable. So again, ownership for an indefinite duration, what's that called? Freehold. Two types of freehold estates. Fee simple, ownership of the building and the land, no conditions. Fee simple defeasible, ownership of the building and the land, but there's a condition attached to the ownership. You can't drink on the property, for example. Now the third type, you'll see this on page 66, the third and final type of freehold estate that we should know about is something called a life estate. It's called a life estate. Now a life estate is ownership, because remember estate means ownership. A life estate is ownership based on someone else's life. So when you own real estate and the ownership is going to last as long as someone else is alive, that is known as a life estate. So for example, let's say that I sold a property to you for as long as you live. Once you die, it comes back to me. That's called a life estate. Now, when are you going to die? Don't worry, it won't be for a long time. But I don't know when you're going to die, so I don't know how long you're going to own it. Anytime you don't know how long you're going to own real estate, what do you have? That's right, you have a freehold estate. So again, remember, freehold is this big, broad category where I own a piece of real estate for how long? We have no idea. One type of freehold estate, fee simple. Another type, fee simple defeasible. And the third and final type is a life estate. This is ownership based on someone else's life. Now, hearing how a life estate works, you might naturally say, wait, let's look at this. I sell you a property, I give you a property for as long as you live. Once you die, it comes back to me. Naturally, your first position might be, well, what if I die first? You might say, hey, look, I give you a property for my life, or for the rest of your life. Once you die, it comes back to me. What happens if I die first? Well, we'll talk about that. The second thing is, you might only be, let's say that you're 30 years old, young. Let's say in the next 10 or 15 years after I give you this property, you want to sell it. Could you sell it? So we'll talk about all that. But just globally, we have three types of freehold estates. Fee simple estate, fee simple defeasible, and a life estate. And as I mentioned earlier in this segment, 99 times out of 100, maybe 100 times out of 100, what are you going to see? That's right, you're going to see fee simple. You're not going to see a fee simple defeasible estate or a life estate as often as you're going to see a fee simple estate. Now, if you look here on page number 66 at the bottom of the page, a couple things that I would take note of on page number 66. The first thing is, can you sell it? Very, very, very common question. Can you sell this life estate? Now, forget this material for a second. Let me just ask you a question, unrelated to this. Does it make sense to say you can sell that which you own? Does that make sense? Yeah, you can sell something that you own. So, for example, if you own a life estate, what exactly do you have? Well, you have ownership for your life. So let's say that you were to sell this property to someone else, right? I sold you a property on a life estate. You're now 30, 35. You want to sell it to someone else. You do that deal. You sell the property to the next guy. 2 days later, you get hit by a bus and die. What happens to your buyer? Well, they got to get out too. The property is going to come back to me. So you could sell it. You could lease it. You could put a loan against it. I mean, you could even walk down to the bank and refinance the property. But the bank is going to look at the title, and they're used to seeing fee simple estates. They're going to see your life estate. They're going to freak out a little bit. But here's what's going to happen. The bank may require that you take out a life insurance policy in the amount of the loan, naming the bank as a beneficiary on the policy. So if you refinance it, they cash you out, you die, the property comes back to me, but the bank gets paid off by the life insurance company. Now, I probably gave you more information than you needed for the exam, but I just want you to understand how some of this stuff works. You can do whatever you want with it as the holder of the life estate, except two things. There are two things that the holder of the life estate generally cannot do. And the easy thing to remember is they both start with W. One thing that the holder of the life estate can't do generally is you generally can't will it. You can't will the property, and here's why. When does your will kick in? When you die. Once you die, you can't say that the property is going to go somewhere else. It's going to come right back to me, right? So the first thing you can't do is you can't will the property. The second thing that you can't do, and it also starts with a W, is commit waste on the property. So if the roof leaks, you got to fix the roof leak. If the property tax bill comes, you got to pay the property taxes. If there's an electrical problem or a plumbing problem or interest on a loan, that's going to be your responsibility, right? So you can't commit waste on the property. You cannot will it, nor can you commit waste upon the property. But you could do whatever else you want. You could sell it, you could lease it, you could put a loan against it, etc. You just can't will it generally, and you can't commit waste upon the property. Now, the next question you might say, or you might have, is, well, what if I die first? Right? I give you a property on a life estate, say you own it till you die. Once you die, it comes back to me. But I die first. Possible? Possible. So, here's how we answer that question. I'm called the creator of the life estate. You're known as the holder of the life estate. The creator of the life estate is going to determine whether the estate is an estate in remainder or an estate in reversion. An estate in remainder or reversion. And you'll see a little diagram of this at the middle of page 66. It's either going to be an estate in remainder or an estate in reversion. Now, let's talk about reversion. My scenario that I've been saying till now, I, seller, give you a property on a life estate. You die, it comes back to me. That's called an estate in reversion. And the word actually kind of makes sense here because what does reversion sound like to you? Reverse, revert, come back to. An estate in reversion is where you die, the property comes back to me. Now, if I die first, you still get to live there. You're good. Until you die. Then once you die, it's going to go to whoever I willed it to. It's going to go to my heirs, right? You can't will it, generally, but I can in an estate in reversion. So I sell you a property on a life estate. Once you die, it comes back to me. I die first. Well, now my heirs are going to get that property, whoever I will it to, upon your death. Now, another possibility is an estate in remainder. Now, think of that word remainder. Think back to like elementary school. Where would you put the remainder? Kind of off to the side, right? You divide 3 over 2. You're going to put that half off to the side. Similarly, anytime this property goes to someone off to the side, it's called an estate in remainder. So here's an example of that. I, seller, give a property to you on a life estate. Once you die, it goes to the Betty Ford Clinic for substance abuse. That's an estate in remainder. It's going to a third party. Now, if I die first in that instance, it doesn't matter because it was never coming back to me, right? It's going to that third party anyway. So what happens if I die first? It depends. Is it reversion or remainder? If it's reversion, it's going to go to my heirs if I die first. If it's remainder, doesn't matter anyway because it's going to that third party. Now, just to compare, here at the middle of page number 67, you'll see something called a leasehold estate. Now, right next to leasehold estates, I would write the words less than freehold. A leasehold estate is a less than freehold estate. Now, that means it's not complete ownership, it's just use. So use of a property, but not ownership, is going to be a lease, right? And it's a less than freehold estate, middle of page 67, or a leasehold estate. Now, right below this leasehold estate piece, exercise 3-1, I'll go over a few of these with you. The answers to the rest are in the back. We'll just do numbers 1, 2, and 3 on page 67. We're just going to identify these as either fee simple estates, fee simple defeasible estates, or a life estate, right? Because those are the three types of freehold estates: fee simple defeasible, or a life estate. We'll start here at the bottom of page 67 with exercise 3-1, number 1. It says, Dennis Holmby has sole possession of Blackacre for as long as he lives. This is called what? Now, he owns it as long as he lives. This is going to be a life estate because it's ownership based on his life estate. How about number 2? Number 2 says, the Middle Falls School has sole possession of Whiteacre on the condition that it be used for educational purposes only. So it's going to be used for educational purposes only. It must be used for some purpose. That's called fee simple defeasible. Right? Fee simple defeasible. It's ownership based on the condition that it be used for a specific purpose. Fee simple defeasible. How about number 3? It says, the town of Merry Meadows has a beautiful library building. The building is a former mansion that was donated to the school, or to the town, with the stipulation that it be used only as a library. What kind of estate does the town have? Again, it has to be used as a library. There's a condition. It's fee simple defeasible again. Now, I'd encourage you to work through the answers at the end of the questions at the end of this chapter. Also work through numbers 4 and 5. If you have any questions, give our office a call. We're here to help. But that ends this freehold estate discussion. Fee simple defeasible, and a life estate. But remember, in practice, 99 times out of 100, maybe more, what are we going to be dealing with? Fee simple, absolute, not defeasible, and not life estates generally. Now, one last thing before I let you go here. With fee simple estates, let me ask you this. Can I have a loan on my property and it still be considered fee simple absolute? Of course. I can, like your house, you probably have a loan on your property, like most of society. Just because you owe money on your property, does that somehow mean that it's not fee simple? Of course not. So you could have a loan, another kind of lien, an easement, or an encumbrance, and it wouldn't change the fact that it's still fee simple. So the presence of an encumbrance does not change the fact that it's still a fee simple estate. Now here on page number 68 and 69, this next section is about taking title to real estate, the way that real estate can be owned. Now broadly, there are 2 ways to take title to real estate. You can take title to real estate separately, or you can take title to real estate concurrently, separate or concurrent. Now, ownership by yourself, if you look here on page number 68 at the bottom half of the page, it's called ownership in severalty. I hate this word because ownership in severalty, naturally, you would think that this somehow meant like several owners or several people on the document. But that's not what this means. Ownership in severalty is actually separate ownership by one person. So ownership by yourself is called ownership in severalty. Now, this word severalty doesn't actually come from the word several. It comes from the word sever, which means to separate or cut off. So ownership in severalty is separate ownership by one person. On the other hand, the other option is concurrent ownership at the bottom of page number 68. Concurrent ownership. Concurrent ownership is ownership by 2 or more people at the same time. So ownership by yourself is ownership in severalty. Ownership by 2 or more entities at the same time is called concurrent ownership. Now let's be honest. What's easier? Ownership by yourself or ownership with more than one person? Ownership by yourself, right? Most things in life, they might not be more fun, but they're easy just to do it on your own. So ownership in severalty is definitely the simpler of the 2. Concurrent ownership is ownership by 2 or more people at the same time. Now, there are 3 types of concurrent ownerships that we should know for the exam. I'm going to start with something on page number 70, just because it's a little more complicated. I'm going to start with joint tenancy on page 70. Now, one thing that makes joint tenancy unique is that joint tenancy has the right of survivorship in it. Now, what's the right of survivorship? Survivorship says if you and I own a property as joint tenants and you die, your share of the property is automatically going to come to me upon your death. Because of survivorship, you and I both cannot will our share while the other's alive. So you and I own a property as joint tenants. You die, your share is going to automatically come to me based on this concept of survivorship. So again, you might want to make a little note here about the right of survivorship, middle of page 70. What is the right of survivorship? The right of survivorship says, upon the death of one of the joint tenants, the deceased share automatically passes to the surviving joint tenant. Now, this transfer actually happens without going to probate. Remember, probate court, and we'll talk about this more in a later chapter, in chapter 4, but probate court is a superior court proceeding where heirs are distributed their rightful share of an estate. So if you die, your share is going to come to me. I do not have to lawyer up and get 7 suits in court, 7 lawyers, to prove to the court that I'm entitled to your share. It's automatically going to come to me without going through probate. Now, on page number 70, a couple notes I would make. Next to survivorship in the margin, I would write the words escapes probate. And you know what that means. I don't have to show up in probate court to prove that I'm entitled to your share, number 1. I would also write, not only that you also wrote it escapes probate, but below that, I would write the words escapes existing unsecured debts. The right of survivorship escapes existing unsecured debts. Now, what that means is, if you and I own a property as joint tenants, and you have $50,000 in unpaid gambling debts, you die. I hate to keep killing you off, but it's my story. One of us has to die. So, you die, your share of the property is automatically going to come to me. Now, you have that big-time gambling debt. It's unsecured, meaning that you haven't pledged the property as collateral for the loan. Your debts die with you. The casino cannot come look to the property to get their money back. Your unsecured debts die with you. So 2 things about survivorship. Number 1, it escapes probate. We know that. Number 2, the thing about survivorship that's important to remember is that it also escapes existing unsecured debts. Your unsecured debts die with you. Now, because of survivorship, you can't will your share, as I mentioned earlier. Right? When does your will kick in? When you die. Once you die, your share of the property is automatically going to come to me without going through probate. Now, a lot of people say, well, is that a good thing or a bad thing, the survivorship? Is it good or bad? Well, I guess that depends on the relationship. For example, you and I don't know one another. Maybe you got a little bit of money, I got a little bit of money. We each put $40,000 and we go buy a little house together and rent it out, split the profits. Now, you and I don't know each other very well, or maybe even at all. Are you going to want, upon your death, for your share of the property to come to me, or are you going to want it to go to your family? Well, you might say, I hate my family. I don't really care about them. But at least you probably want the choice, right? You probably want the choice to send it to a friend or family member or coworker. You probably don't want it to automatically come to me. Now, who would joint tenancy make sense for? A lot of people say, well, people that are married. Well, married people in California have community property, which is similar, but we'll talk about that in a few minutes here. But really, I'll give you some examples of who joint tenancy might work for, but please don't misunderstand me. I am not giving you advice on how you should vest, how you should hold title, and you should never give a client advice on how they should take title to real estate, because how you take title to real estate can have serious tax and legal consequences. So we never want to get into a position where we actually give a client advice on how to take title to real estate, ever. Because again, if you give them the wrong advice, just tell them to see, this is, by the way, this isn't decided at the time you write the offer. How you vest is actually decided after, right? How you vest is decided like in escrow. So the real estate agent is less in the picture at that point to even give this advice. But never give a client advice on how they should take title to a piece of property. Now, you'll see on page number 70 at the middle, you'll see the letters TTIP, T-T-I-P on page 70. Now, these are the 4 unities to a joint tenancy holding. T-tip are the 4 unities. Now think of that word unity. Does that sound like something that's the same or something that's different? It's the same, right? Unified, unity, it just sounds the same. So the 4 unities that are the same in a joint tenancy holding are a unity of time, a unity of title, a unity of interest, and a unity of possession. Time, title, interest, possession. Now, let me go through these one by one. Let's say you, me, and a friend of ours, the 3 of us, buy a building together as joint tenants. The building at the height of the market, we were making like $30,000-$40,000 a month. I mean, we were doing really well, right? We're all having a good time. We're making money. We're going out to eat. You know, we love each other. We love life. Unfortunately, as the recession started to take hold, a lot of those tenants started going out. So now instead of making 30 grand a month, we're like losing 5 grand a month. So each one of us are coming out of pocket each and every month to keep this thing going. Now, you say, you know what, this sucks. I'm a business person. I'm in the business of collecting checks, not writing them. So you decide you're going to sell your share to someone else. Now, the 2 of us are still going to be joint tenants together, but the person that you sold the property to will not be a joint tenant with us. Rather, they're going to be a tenant in common because they're violating the unity of time. All joint tenants must take title to the property at the same time. They also have to take title to the property with the same deed. If you look at number 2, the second T in T-tip is title, meaning that all joint tenants, their names are going to be listed on the same deed. You have 100 joint tenants, you might picture like a big scroll, and all 100 names are listed on the same deed. There's a unity of title. Look at the next one. There's a unity of interest, meaning, this is the one I hate the most, frankly. Let's say the 3 of us, you, myself, and this other person, the 3 of us bought a building together. It was $10 million. You put up $8 million, this guy put up $2 million, and I put in a big fat 0. If we add the words as joint tenants at the end of our names on the deed, all of us are going to have a unity of interest. I'll loan a third, even though I didn't put in any money. You'll loan a third, even though you put up the vast majority of the cash. The 4th and final unity to a joint tenancy holding is a unity of possession. Now, I call this the touch unity, T-O-U-C-H, the unity of touch. All joint tenants have an equal right to possess, use, and touch the entire property. If you and I own a property as joint tenants, we cannot draw a line down the middle of the room and say, okay, that half is yours and this half is mine. We have the right to possess and use and occupy the entire property as joint tenants. Now, with regard to joint tenancy, one other thing you should remember is if you think about survivorship, who actually wins with survivorship? Well, frankly, whoever wins is the guy who lives the longest. Because whoever lives the longest, if there's 100 joint tenants, as the 99 people die, the person left is going to own the property in severalty because the joint tenancy keeps going to the surviving joint tenants. When does a corporation die? Never, right? Corporations have perpetual life. They could live forever. That's why a corporation cannot take title to a property as a joint tenant. The corporation would always win. Now, corporations can own real estate. Please don't misunderstand me. It's just that a corporation cannot take title to a property as a joint tenant because of the perpetual nature of the corporate entity. Now, tenancy in common is a lot more simple than joint tenancy. The first thing I would do, back at page number 68, we just finished up joint tenancy. Let's come back in the book to tenancy in common. Now, one thing I would write here at the bottom of page number 68, next to tenancy in common, I'd write the words, no right of survivorship. Tenancy in common does not have the right of survivorship. Now, that means that once you die, you can will your share. It's not automatically going to come to me. So first thing I would write at the bottom of 68, tenancy in common, no right of survivorship. You had a right of survivorship in joint tenancy. You don't have a right of survivorship with tenancy in common. The other thing that I would look at here at the bottom of page number 69, you'll see the term unity of possession in bold at the bottom of 69. Remember, joint tenants had 4 unities: a unity of time, a unity of title, a unity of interest, and a unity of possession. Tenants in common only have a unity of possession. There's no unity of time as a tenant in common, which means it's easy to add and subtract tenants in common. There's no unity of title as a tenant in common, meaning that you could have 5 owners and all 5 might have different deeds to the property. There's no unity of interest. So if you put up $800,000 and I put up $200,000 on that $1 million purchase, you could make it so that you own 80% of the property and I could agree to only own 20% of the property. You don't have to be 50-50 like you do as joint tenants. Now, as tenants in common, if you and I wanted to be 50-50, we could, but we don't have to be. In joint tenancy, you must own an equal share. The only unity that we have to follow as a tenant in common is a unity of possession. And that's what this says here on page number 69, a unity of possession. So even if I only own 1%, you can't stop me from touching and using and occupying the entire property. So joint tenants, time, title, interest, possession. Tenants in common, just possession, no unity of time, no unity of title, no unity of interest, and the only thing we have is a unity of possession, but there's no right of survivorship. Tenants in common, no right of survivorship. So what could you do as a tenant in common that you couldn't do as a joint tenant? You can will your share as a tenant in common. Now, let's say that you bought a house last year, and you bought it with a buddy, and you're kind of scratching your head like, damn, I don't remember how I held title. I don't remember if it was tenants in common or joint tenants. I just don't remember. What document could you look at? You could look at the deed. And the deed is going to show whether you were joint tenants or tenants in common. But what's kind of weird to wrap our minds around with regard to deeds is, you know, the deed to your house. Let's say you have regardless of how much your house is worth, it's still a pretty expensive thing. What's nuts is that the ownership document to that particular piece of real estate is not printed on like some special government paper and some special government facility behind armed guards, like dollars are, right? Dollar bills are printed at the mint, and there's like all sorts of bulletproof glass and guards everywhere for a dollar bill. The deed to a $1 million house or a $50 million building is printed in an escrow office on regular HP LaserJet printer from Walmart, or with a regular paper from Walmart, or Office Depot, or whatever. So let's say that you have an escrow officer. You and your buddy bought a house together last year. The escrow officer leaves out the vesting. It just has your name, Fred Flintstone, and your buddy's name, Barney Rubble, and period. There's no vesting mentioned. If no vesting is mentioned, the law will presume that you have held title not as joint tenants, but as tenants in common. When no vesting is mentioned and the parties are not married, the legal presumption is that you have held title as tenants in common, not as joint tenants. Why is the default not joint tenancy? Well, think about it. Joint tenancy is just so damn heavy, right? You have the right of survivorship. You can't will it. Unity of time, unity of title, unity of interest, unity of possession. It just weighs on you. If you want joint tenancy, what do you have to do? You got to call it. You got to specify it in the deed. So if no vesting is mentioned, the legal presumption is that parties have held title as tenants in common as long as the parties are not married. Now, I mentioned that tenancy in common was the default if the parties were not married. If no vesting is mentioned in the deed, the legal presumption is that the parties have held title as tenants in common, unless they're married. If you look at page number 71, this is community property. Community property California is a community property state. All of our other real estate laws, you might remember this from chapter 2, all of our other real estate laws actually come from England. They come from English common law. The exception to this, of course, is this concept of community property law. Community property is actually a holdover from Spain. So again, all of our real estate laws come from England, except this concept, which is a holdover from Spanish law. Now, once you decide to get married, all of your stuff is going to break down into one of two categories. It's either separate property or community property. And you'll see this here on the bottom of 71. What is separate property? Separate property is generally the stuff that you had prior to marriage. Generally, the things that you had prior to marriage are considered separate property. The things that you get during marriage are considered community property. But that's not entirely 100% accurate, because it is still possible, even though you're married, to get stuff and have that stuff be considered separate, even though you're married. I'll give you an example, and I'm just going off this list at the bottom of 71, these 3 black squares. Number 1, by gift or will. So if it's my birthday, somebody says, hey, Kartik, happy birthday, man, here's $1,000. Like, wow, $1,000, holy cow, I haven't been this excited since I was like 8 for my birthday. Thank you. Now, if I'm married, that $1,000 is considered separate property, right? If my uncle dies and in his will, he leaves me $50,000, that's also considered what? Separate property, right? Because it's gift or inheritance. Now, that's true until I commingle it. If I'm so stoked I got that $1,000 gift for my birthday, I run straight to the bank and deposit it in a joint account, I may have problems now because I may have commingled, it looks like I've commingled them and it's become community property. I put that $50,000 check from my uncle in my joint bank account, I may have problems. Look at the next one. With the proceeds or income from other separate property, the last 2 squares on page 71. So let's say that I had a house in Fresno before I got married. I list that house in Fresno and sell it, and now I'm married, and I buy another property in San Diego. The next property I buy in San Diego, assuming I only use that Fresno money, because I had that house before I was married, if I only use Fresno money to buy that next property in San Diego, that little investment property, is still considered to be separate property. But there's 100,000 things that I could say that might change that. For example, maybe I was making the mortgage payment for that house in Fresno out of a joint account after I got married. Maybe I was paying the gardener out of my joint account for that Fresno property. Maybe I used some Fresno money to buy that investment property in San Diego, and I used some community funds to buy it. So again, the state exam isn't a family law test. Of course, they call them family lawyers, but they really get paid big money to break apart families. But the point is that this state exam isn't going to get that complicated. Our test isn't going to get that complicated. Assume a guy has a property in Fresno before he gets married. Then he gets married. He only uses that Fresno money to buy the next property. That next property is still considered what? Separate property. Now, of course, you know there's 100,000 billion trillion things that could change how that actually plays out. But from an academic perspective, that would be how it would work. Now, let me ask you a couple other things here real quick on page 71 about community property. One thing is it true in California generally that a contract signed by one spouse is binding on both? Yeah, that's true. A contract signed by one spouse is generally binding on the community. Now, what that means is, for example, Kobe Bryant was going to get a divorce. His wife was going to get something, it was reported, something like $75 million. She never hit a layup in her life. Does not have Kobe's three-point shot. But she's still entitled to half of what he has during marriage because it's generally considered community property. So if you get this concept on the exam, how many signatures do you need to list a piece of community property? Just one. Because if the wife signs the listing contract on community property, it's binding on the husband also. So I'd write at the middle of page 71, I'd write the words one signature to list. However, below that, I would write the words two signatures to convey. So one signature to list, two signatures to convey title. Now, fine, I might have a valid listing with just the wife's signature, but I don't want to win an argument, I want to get paid. So if the wife is saying, look, I'll just sign it, my husband will sign later, fine, get her signature, but you want to come back for the husband's anyway, because once you do find a buyer and it comes time to transfer title, they're both going to need to sign the deed or it'll cause a cloud on the title. So just be aware of that, right? One signature to list, two signatures to convey. So what's the best definition of community property then? Community property is all property acquired during marriage that is not separate. We need those four words at the end. That is not separate. Why? Because we know that it's still possible through gift or will, for example, to get stuff and have that stuff be considered separate property even though you're married. So if you look here on page number 72, we talked about community property, but I do want to share something with you, and it's on page 72. There's another type of community property called community property with the right of survivorship. And basically how community property with the right of survivorship works is it's just like community property, husband and wife, except when you have regular community property, you can will your share as a husband or wife. You can will it. When you have community property with the right of survivorship, it has the survivorship element just like joint tenancy does. So the husband and the wife own it 50-50, but upon the death of the husband, it automatically goes to the wife. And if the wife dies first, it automatically goes to the husband. That's survivorship. Regular community property doesn't have that. So we have this other thing in California called community property with the right of survivorship, and it would work in the same way that survivorship would work with joint tenancy. Now, there are some corporate forms of ownership, and I do want to show those to you on page number 74 at the bottom. The different corporate forms of ownership, business ownership of real estate. Now, the simplest way at the bottom of 74 and all of 75 is the sole proprietorship. Now, as a sole proprietor, it's just you. You are personally liable for everything that happens. So if you're a sole proprietor and something happens on your property, God forbid, you're personally liable for that. Now, that's different than a corporation on page 75, and a corporation, of course, is a legal entity. It's like Apple Computer is a corporation. So if Apple gets sued, just the corporation is getting sued. The shareholders aren't getting sued. So a lot of times you have real estate investors put their property in a corporation. Now, you'll work with your own tax and legal advisors to figure out what's best for you, but the corporation can limit liability, as it says on page 75 in this gray box. It's a separate, legal, recognized entity apart from the shareholders. It must be chartered by a state. In California, the Secretary of State issues corporations in California. If you want to start a corporation, you'll have to apply with the Secretary of State in California. Acts through a board of directors and officers. May own, lease, and convey real property. But remember, a corporation cannot own property as a joint tenant because a corporation never dies. And of course, it limits the liability of officers, directors, and shareholders. Now, without getting too deep on page 75, the corporation can take one of two forms. It can take the form of a C corporation or an S corporation. The benefit to an S corporation over a C corporation is that the S corporation can avoid double taxation. Let me explain. A regular standard corporation, let's say the corporation makes $1 in profit. Now, the corporation is going to pay tax on that dollar, and let's say that there's two shareholders, and the corporation distributes that dollar profit to the shareholders in the form of a 50-cent dividend each. Now, the corporation is going to pay a tax on that dollar in profit, and then the shareholders are also going to pay tax on the dividend. Now, what's kind of messed up about this is that the government gets to collect tax twice on the same dollar of profit. Once at the corporate level and again at the shareholder level. So this is kind of what makes a C corporation less desirable than the S corporation in some instances. The S corporation avoids double taxation. So C corp, S corp, both corporations, but the S corp is an election that would avoid double taxation. Now, if you look at 76 and 77, you could have a partnership. Now, on page 76, a partnership is kind of like two sole proprietors coming together for an aim. Now, in that partnership, each partner is going to be jointly and severally liable for what the partnership does. So in a standard partnership, you have theoretically unlimited exposure. Now, a limited partnership on page 76, a limited partnership, you have one general partner that kind of makes decisions. He may have unlimited liability, or she may have liability. Then there's limited partners. Their liability is strictly limited to the amount that they invested in the company, right? Partnership, everyone's exposed. Limited partnership, the limited partners are only exposed as far as their initial investment. You have an LLC at the bottom of 76 and top of 77. An LLC, or limited liability company, is another way, another corporate structure that you could use to own real estate. Now, remember, an LLC, you might remember this from chapter 1, if you have a real estate company and you want to license or get the LLC licensed as a broker in California, you can't do that. California, the real estate commissioner, does not recognize LLCs as brokers in California. It's got to be either a partnership, sole proprietor, or a corporation. Now, another thing on page 77 here, you'll see real estate investment trust, or a REIT. Now, a REIT is a pass-through entity, so a REIT also avoids double taxation. But there's a lot of rules. It can be favorable from a tax perspective, but the REIT, there's a lot of rules. For example, there has to be a certain number of owners. You'll see this at the bottom of page 77. It must be owned by at least 100 different investors. You can't have a lot of the ownership concentrated in just a few people. It's got to kind of be spread out. It's got to invest in real estate. So those rules that govern the real estate investment trust also, it's a syndicate. It's a way to pool money together to purchase real estate. So a lot of stuff we talked about in this chapter. Chapter 3, we talked about fee simple. We talked about freehold estates. We talked about the different types of title vesting and some of the corporate forms of ownership. Good luck with Chapter 3, and we'll talk to you guys soon.